A very good evening to you all. Welcome to today's session on FINLIT, which typically means financial literature with capital L's. So the objective of today's session is to educate participants on how they should effectively manage their wealth in turbulent times like this, when we're seeing record high inflation, with a depreciating currency, with a complete economic turmoil. How do you kind of manage your money in this kind of environment? So we'd like to help you out in terms of how to kind of look at investments in periods like this, and how do you time the markets to kind of effectively capitalize on periods like this. So effectively, we'll start with a session in terms of what do we have on offer, what are the best investment options right now on the table, and thereafter we'll be happy to take questions from the audience. And if you have any questions, please feel free to drop your questions on the chat, and we'll be happy to take your questions. So to get into things, let me first introduce CAL, or Capital Alliance. So Capital Alliance is a full-fledged investment bank, which has operations in fixed income, investment banking, equities, and asset management. When you say investment banking, this is beyond your traditional banking. So we look at alternative investment asset classes, which could facilitate both borrowers and also investors in terms of optimizing their return in terms of investments, right? So from a fixed income side, our fixed income department basically is one of the non-bank primary dealers in the country, or one of the largest non-bank primary dealers in the country. What we do is, through that unit, we buy and sell treasury bills and bonds. So we act as a facilitator for the government to raise money from the public, right? And also we facilitate transactions for papers like debentures, commercial papers, where we help companies raise money through debt securities, and connect the investors to invest in those type of corporate instruments, right? Our investment banking vertical basically gets involved in initial public offerings, which is raising equity capital for businesses. Not only is it for public offerings, but also if you're a private company looking to raise money, our investment banking team kind of helps you out. Not only is it on the equity side, but also on the debt front, we help companies raise debentures, securitization, multiple fixed income securities that we kind of structure based on the requirements of your business and so on. We kind of help them to kind of create customized financial products, right? Also on an M&A side, we help companies merge, acquire, and so on from a growth perspective, right? Our equities arm is basically gets involved in terms of stock brokering business, where we help clients trade equity shares based on the recommendations given by our research team. And also we have a margin lending function, which helps investors in terms of allowing them to borrow to invest in shares and so on, right? And the final vertical that we have is what we call as asset management, or the wealth management division, which is one of the largest asset management companies in Sri Lanka. Our unit trust is the largest unit trust in the country. We manage in excess of 78 billion rupees right now through unit trust and what you call as private wealth management portfolios, where under private wealth management, we create customized portfolios which fit your requirements in terms of investment. So this is just to give an introduction in terms of CAL. A little bit, more achievements from our end. So we are number one in terms of Sri Lanka's post for equity raisings. We've raised over 20.3 billion rupees via the stock exchange in a post-war period. We have a 34% market share in debt issuances or fixed income issuances last year. We are the market leader in mergers and acquisitions advisory for listed companies. And we are the only AA rated unit trust in the country, rated A by Fitch and A+ by ICRA. And as I mentioned to you, we are the largest unit trust in the country and manage in excess of 78 billion rupees. Yes, it's almost greater than some of the smaller banks that we're looking at. And from a research perspective, our research team has been actually awarded the best research team by CFA for 3 consecutive years. So equity research backing helps us to make better decisions on an equity front. Right? So that's a little bit of brief in terms of Cal before I come to the main discussion topic. Right? So you may be wondering, and the biggest question that comes to your mind right now is, how do I kind of manage my wealth in periods like this, right? So your economic variables have gone through the roof, right? Your wealth in dollar terms has significantly deteriorated. Your savings have substantially reduced. How do you kind of manage your wealth in this kind of situation, right? And your typically two largest impacts that you see is the impact of inflation, which is escalation in the product prices, and the rupee depreciation, right? And the impact of rupee depreciation has been in the form of your product prices going up, right? And also your wealth. If you're going abroad, traveling abroad, the amount that you can spend abroad is now restricted, or is probably 80% lower than what it was before, right? So is there still a way that you can build up or recover what you have kind of lost in the last 12 months, right? So if you look at the current scenario right now, so inflation right now is at about 60%, right? And why inflation has been this size, obviously due to multiple reasons. Starting off with the excess printing that the central bank has been involved over the last 24 to 36 months. So if you look at the left-hand side graph, it shows the amount of money printing that the central bank has been doing over the last couple of years, right? So 2020, we printed about 651 billion rupees. And even in 2022 until now, they printed close to 695 billion rupees, right? So the excess printing, if you look at those last three bars in this graph compared to the previous bars, you can see the extent of printing, how significant that it was compared to the previous years. The good thing is that now you see central bank kind of reducing the amount of printing, especially the last 2 months. They have reduced the amount of printing and are coming to the market at higher rates to borrow from the market, right? So which effectively will reduce the inflation impact in the months to come, right? So money printing was one of the main reasons which led to this crisis, right? Not only on inflation, but also on the exchange rate. Second is the impact of the rupee depreciation, which had on inflation, and it's all interlinked, right? The printing led to depreciation, and the depreciation kind of triggered down into inflation. Right? And also the second most important thing was our shift to organic fertilizer, which had a significant cost in terms of our food prices increasing. Right? And third is obviously when globally there were supply shortages with COVID restrictions coming in, and now even with the Ukraine war, disallowing exports from Ukraine and Russia were major exporters in terms of wheat, fertilizer, and so on. So all that restrictions also exerted pressure on costs and pricing. Right? And when globally things started opening up after COVID, you saw people aggressively starting to go on a revenge spend, which kind of increased demand for products and services, pushing prices high. Right? So this is why inflation has been pretty high in recent time. But from our perspective, what we believe is that this kind of inflation is not going to be continuous as such, right? And why we say this is not going to be continuous is because if you control on money printing, right, which the central bank governor is working on right now, the amount of pressure on inflation will substantially subside, right? So you might see inflation even hitting about 70% level next month, right? But if you look at the average for this year, we're talking about 50%, right? But next year, you will see inflation easing off, right? And that is also because of things like oil, which went up to $130, $140, is now starting to ease, with globally things starting to go into recessionary territory, right? So if recessionary environment kind of prevails, globally demand for products and services that will go down, which means that the prices from your wheat to oil to sugar to milk, which have gone up on a global basis, will start adjusting downwards, right? So inflation is going to be a one-off phenomenon, right? Provided that the central bank doesn't keep printing money in this way, right? So what do you do in this kind of environment, right? So typically what you would have done, or how majority of investors in Sri Lanka manage their money, is by parking their money in a typical bank deposit, right? And your bank deposits typically were yielding something higher than the government treasury bills or treasury bonds, or and more or less covering up for inflation over the last couple of years. Right? So Sri Lanka has at about 5% inflation, but the returns on banks' deposits have been about 9-10% on average over the last couple of years. Right? But this trend has completely changed now. Right? Now, with inflation being this high, the bank returns are not giving that kind of returns that we were looking at before. Right? Which is the alternative asset class that I'm talking right now, which is treasury bills and bonds. Right? So in terms of treasury bills and bonds, like how banks take money from you, in terms of a treasury bill and bond, it's a government which raises money from you. So it works almost like an FD. You're giving them money for starting from 3 months on a 3-month table, going up to even, you can even invest in a T-bond, treasury bond, which can go even up to 10 to 20 years if required. Right? The good thing with treasury securities or treasury bills and treasury bonds is that these are government-backed securities. Right? Obviously, I know you have the question in terms of, will the government pay? Do they have, they're almost bankrupt. How are they going to kind of pay? So the good thing is that since the treasury bills and treasury bonds are rupee denominated securities, right? It's in rupees. Right? The central bank can always print you and settle. There's a default scenario. The government income is not enough to kind of pay for the expenses. The central bank can always print and settle. Right? But obviously they can't print dollars, which is why we are unable to pay our foreign debt at the moment. Right? So the good thing is that we call treasury bills and bonds a risk-free instrument. Right? So you basically don't have a risk. So if you look at prior to 2019-20, right, your treasury bill rates were always lower than the bank deposit rates. Right? Now this phenomenon has changed. Now you see the government treasury bills and bonds are way higher than what the banks are offering at the moment. Right? So there is an opportunity here. There is a abnormal fixed income return that you can kind of capitalize on. Right? So what do you need to do now? I've clearly mentioned that inflation is going to be a one-off phenomenon. Right? For a couple of more months, you might see it edging up to even 70%, but thereafter you might see that starting to edge downwards. Right? So these interest rates that we are seeing right now, right, are not going to last for long. Right? So keep in mind that, for example, treasury bill rates even went up to 30 to 32% last month. Right? These are abnormal returns. Sri Lanka has never seen these kind of returns in the last, I don't think in the history we've seen these kind of rates. Right? So what you need to do is capitalize on these rates right now. Right? So when rates are higher, you need to lock in your rates. Right? You need to lock in long-term instruments. Right? Treasury bonds are longer-term instruments. So if you want to kind of beat inflation in the next 2-3 years and cover up for the loss, what you need to do is to invest in long-term instruments like treasury bonds, right, for 3-4 years. Okay? So if you look at the graph here, I basically put in the pink line which I've shown here is basically the return that you're making on a, say, for example, a 5-year treasury bond. Right? Your average now returns are somewhere around 23 to 25%. Right? So if you invest in a treasury bond, you will get a 25% return per annum. Right? Every year you get 25% as a return. Right? So the blue line here, so the pink line is basically the treasury bond return, and the blue line is basically showing what the inflation rate is. So if you look at the year 2022 here, right, your inflation is greater than, right, the interest rate that you're making. Your interest rate is 25, but your inflation is 50. Right? But after 2022, when inflation starts coming down, right, you start making a positive return, right? Because you'll still be making a return of 25% on the portfolio of bonds that you have, right? But your inflation will come down to about 10%, right? It will be still higher than the average of 5% that we've seen in the past, but it will be averaging at about 10%, right? So you make a net 15% return on a real basis, right? So even though you lose out in the year 2022, by locking in your rates now for a long period of time, you will be able to kind of beat inflation in the medium term, right? So that's one angle of looking at how you can beat inflation. So you go long, right? You don't keep parking money for the short term, because these rates that you're seeing in the market right now, especially for government securities, are not going to last long. right? So probably it might be there for 6 months or 12 months. When things like an IMF program comes in, which is most likely to come within the next 6 months, you might see the rates start easing off, interest rates starting to come down, right? So it's a one-off phenomenon that you need to capitalize. And this is a good opportunity to capitalize, given that at the moment, rates are still holding high, right? And inflation, we are now seeing signs of inflation, right? You'd have heard there's a possibility of fuel prices coming down, right? Vegetable prices are starting to come down with harvest being good. So these adjustments are now starting to happen. So inflation in a couple of months will start edging down. You might not see the 60%, 70% inflation that you're seeing right now being visible in 6 months' time, right? So you need to lock in your money right now for longer term instruments to beat the impact of inflation, right? The other important aspect, and which has been a big worry for a lot of investors who have their money in rupees, is the impact that has been caused by the rupee depreciation, right? So the currency, which was at 200 rupees at the beginning of 2022, has gone to now 360 rupees to the dollar, right? So roughly about 80% increase. If you're buying something, it's 80% more, right? So in dollar terms, if you had wealth before, it would have seen a substantial reduction, right? Say, for example, if I had $10,000 at the beginning of the year, right, the value of it today, right, $10,000 as the beginning of 2022, right, is only equivalent to $5,556 today, right? That's a substantial reduction that we've seen in terms of the reduction in terms of how much the dollars that you would have had. But can you cover up for it? So your dollars that you had was $10,000 before, now which has become $5,550, right? So can you really get back or recover the lost dollar wealth in the next few years, right? Yes, there is a way. And the route is still, as what I said, is going and locking long in treasury bonds, right? For example, right, let's put things into perspective. If you had, say, for example, 2 million rupees at the beginning of 2022, right, that would have been equivalent to $10,000, right? I'm talking about graph one here, the blue color graph. You would have had $10,000 at the beginning of the year, right? If you were holding dollars, right? And the dollar, if you had parked this money overseas, let's say, you would have made a return, which is about 3% or 4%, right? And if you park that at a 3% return for 5 years, your $10,000 will become $11,500 in 5 years' time. Right? By investing at 3%, your $10,000 will become $11,500 in 5 years' time. Right? Let's now look at if you had rupees. Right? So we said if you had 2 million rupees, right, which should have been $10,000 at the beginning of the year, right, with the impact of the currency has fallen to $5,550, right? If you take this $5,550, right, look at the rupee value of it right now, which is 2 million rupees, right, and invest in a treasury bond, which is yielding something very north of 23%, right, for 5 years, right? At the end of 5 years, right, even after assuming that Sri Lankan rupee will fall by 5% every year, right? The final return that we make will be $12,200, right? So a $5,500 will become $12,200 in 5 years' time, right? And this is because the exceptional returns that we're making on the rupee denominated government securities, right? So when you're investing at 23, 24% kind of levels, right, the interest rate that you're making is covering up for a lot of the impact of the rupee depreciation. So basically, you're only making about 11,500 in 2027 if you just maintain your money in dollars. But now you've beaten it in 5 years' time, right, by investing in rupee denominated securities and converting into dollars in a future period, right? So even in 2027, even if your currency is at 450 rupees to the dollar, right, you're still able to beat the impact that has been caused by the currency depreciation, right? So by investing long, by capitalizing on these rates right now, you're able to beat not only inflation, but also the impact of the wealth reduction that you've seen from your treasury bonds, by investing in treasury bonds and so on, right? So one strategy is to lock long go for longer term securities, capitalize on these abnormal rates, because these rates are not here to stay for long. You might see these kind of rates lasting 6 months or so, but there's going to be an adjustment which happens thereafter. Right? So like what I said, if you look at the current yields on treasury bill, the 1 year treasury bill right now is at 28%. Right? If you look at your bank deposits right now, bank deposits are averaging at about somewhere around 12 to 17.5%. Right? So the government securities are yielding a higher return compared to what the banks are offering you right now. Right? So bank rates are pretty low in this kind of environment. Right? And if you look at the graph here, it clearly shows, right? If you look at the graph here shows the treasury bill rates from 2013 to now. Right? And you can see these are one of the highest rates that treasury bill rates has gone to. Right? So one of the very significant and a very easy to invest product right now in the market is what you call as a treasury bill issued by the government of Sri Lanka. Right? So as I said, the risk is averted because the government can always print rupees and settle. Right? Because of that, on rupee denominated securities, you won't see the government not being able to pay you back. Right? So if you look at the current rates, if you're buying treasury bills and bonds from say Cal at current market rates, these are the rates on offer right now. Right? So on a 3-month bill, you're getting roughly about 25%. 12-month bond will, the 12-month bill will go to about 26.5%. Right? So you just invest. It's similar to a deposit. Right? So you give money and you in 3 months time with the interest you get your money back. Right? And if you are looking at long-term instruments like what we said, a 3 to 5 year security or 3 to 5 year investment will yield somewhere between 22 to 23 kind of percentages. Right? So by investing long, you are able to kind of meet or beat the impact of inflation and the impact of the currency depreciation. Right? On that same context, right? So the general question is, okay, I have X amount of money, but what can I do if I put everything in a 5-year security? How do I live? How do I run my day-to-day expenses? Right? So you also have a liquidity requirement that you need to kind of manage right now. Right? So just to recap, we are only talking about products which are attractive to you right now. Right? So our product spectrum is quite wide. So we do commercial papers, securitizations, debentures. There are various products that we do, but at the moment, the two hot products in the market right now are treasury bills and treasury bonds, which are government issued securities, which are yielding a higher return. Right? If you ask me the same question, whether it was treasury bills and treasury bonds, which were the attractive asset class last year, no, it was not. Right? Last year, you had equities or share market, which was doing well. Then you had alternative asset classes which were doing well. And at that point, last year, your T-bill, treasury bill, was only giving you 5 to 7%. Right? So with this one-off adjustment that we are seeing right now, this is the most attractive asset. Right? So now Shehana will take you through in terms of liquidity. If you have day-to-day requirements, right? So say for example, you have an investment company. For example, say you make 100,000 rupees. Right? You have your savings, whatever you made up to now, all that being parked in a 5-year treasury bond, right? That you're locking loan to cover up for the impact of inflation and exchange rate depreciation, right? But what do you do with your salary, right? That is not something that you can then park for 5 years, no? Obviously, you can put a portion of it to the long run, but you might have to manage your liquidity, right? And 1 year down the line, you might have to pay your kids' tuition fee, his education fee. You might have your wedding plan in a year's time, right? How do you manage that liquidity? You need to have liquid cash with you, right? Cash that you can easily take out from an investment, like what you're doing with the savings deposit, right? So let me pass it on to Shehana, who will kind of give you a little bit of guideline in terms of what you can do to kind of manage liquidity in the current context.
Thank you, Udeeshan. I hope I'm clear. My voice is clear to you guys. So, like Udeeshan rightly said, uh, when you actually plan your finances, or you need to kind of think in the short, medium, and long term, traditionally, us as investors are used to two main products that would have been the bank FDs and the bank savings accounts. So you as an investor would have actually invested as an investment. The first product that you would have gone for are the bank fixed deposits, and then for day-to-day use, you would have used the current accounts or saving accounts. So as you very well know, the returns or the rates that the bank traditional deposits rather give is very low. For example, as far as I know, the bank savings rates are around 4 to 5% on average, and FD rates hover around 15 to 17%. And some banks use special rates for different promotional periods above a certain threshold. So if you look at the entire gamut of investments or savings in the country, if you look at the pie chart on your left, you can see that the majority of investors in Sri Lanka actually 61%, that's a very staggering number, actually invest in savings accounts. That's yielding only 3-4%. So at the end of the year, just imagine what kind of interest income that you will yield from your investment. And around 40% invest in bank fixed deposits, which are the most popular investment product, I would say. And only 3% actually invest in alternate asset classes, like what we just spoke about, the treasury bills and bonds, unit trusts, commercial papers, debentures. Number one is because not many investors know about these products. And you also, because you don't know about the products, you actually have a kind of a stigma because you are very familiar with the bank FDs, you know how it works. There are so many branches available. But to be very honest, there are a lot more other fixed income yielding instruments that give you far more attractive yield. So if you take a look here at the right-hand side, if you actually invested, let's say, for example, you are investing 1 million rupees, and we are actually taking into consideration that the bank savings account rates are on 4%, and the unit trust rates in my case. So it's yielding on average around 18-20%. So if you had actually invested in unit trust fund, which gives very similar liquidity, almost identical to a savings account, you would have actually earned interest amounting around 220,000 at 22% annual effective rate for a 1 million investment. On the other hand, if you had actually invested the same 1 million in a savings account, you would have only earned around 40,000 rupees for a year's time period. So you're actually losing out around 180,000 rupees in a year by just deciding to have it in a traditional deposit and earning a very low return. Next slide, Shan. So just to give you a brief of what a unit trust fund is and why that could actually be one of the best options to go for to manage your liquidity. So what actually makes the main components of a unit trust fund, I'll explain to you in a very simple form. So what happens in a unit trust fund is that investors like yourself, thousands of investors actually invest. They pool all of their money in. Maybe I myself might invest 1,000 rupees, then you might invest 1 million, and another might invest 100,000. So all of the investors actually pool their money in, and at that point, a fund manager, or in this scenario, Cal, decides where they need to invest this money. So we as fund managers invest this in a plethora of investment instruments, such as fixed deposits, treasury bills and bonds, commercial papers, debentures, trust certificates. So the entire gamut of fixed income instruments that are available in the Sri Lankan market, we invest in. So you're actually getting a personalized, diversified product on behalf of you. So I think you must be knowing one of the rule of thumb when it comes to investing is to not put all of your eggs in one basket. So diversification is one of the most important things. But trying to do it on your own, when you try to, kind of go through all the financial statements or P&Ls of certain companies, 20 different companies, and doing on your own is a very time-consuming and cumbersome thing to do. But unit trust funds actually diversify these risk to return and give you a very well diversified portfolio, your own portfolio, which you can actually enjoy the returns as well as liquidity. So coming back to the best, I mean, why unit trust fund is the best option for you. Number one is the higher return. You actually get returns higher than the bank FD rates, but with phenomenal liquidity and professional expertise. So like I told you earlier, fund managers, this is their bread and butter. You might be a doctor, you might be a you might be an accountant in a PLC, or you might be actually into art or any kind of profession. But as fund managers, this is our bread and butter. So what we do on a daily basis is to kind of review these companies that we invest in. We thoroughly go through their financials. We see how their cash flows are. We see if this company can actually pay us back, pay the investors back. And then we decide what to invest, how much to invest, and how long to invest. So one of the main things in a volatile investment climate like this is to figure out how long I should invest. For example, if you had actually invested in a fixed deposit before the month of March, before the policy rate hike at around, let's say 7-8%, and when the policy rate hike happened overnight, bank FD rate shot up to around 15-16%. And you would have, I mean, as an investor, if you had done that before month of March, you would be regretting this, thinking, you know, what do I do now? Because in case you want to take the money out from a bank FD, you need to pay a certain penalty. So as fund managers, it's vital that we kind of map the duration that we take for the investment so that we can actually be very competitive with the market rates. And like I told you, diversification. So we kind of, to explain further onto that, so unit trust funds on average have around 15 to 20 different companies that it invests in, which means that you actually get a very expansive diversified portfolio. And at any given time, for you to lose, let's say you invested 100,000 rupees as your starting investment, and for you to lose that 100,000 rupees, all the companies that the fund has invested in, company A, B, C, D, E, F, or all the 20 different companies, all of them have to go bankrupt for to lose all of your money. So for example, let's say you had only invested in one different, on one specific financial company, all of your money. At any given time, if that particular finance company goes belly up, all of your money is compromised. But in a unit trust fund, which is well diversified, and this is very well regulated by the Security Exchange Commission, the fund manager is only allowed to invest up to a maximum of 15%, a maximum at any specified company. So we can only take that amount of exposure to any company. So we can't actually go just because we think that this company is giving a higher return, because we are bound by the regulations by the Security Exchange Commission. We cannot actually go and park 80% of your money at one company just because they're giving a high return. So there are so many regulations and rules that are entwined with unit trust funds that kind of, you know, ensures the investors' interests are met. And number 4 is liquidity. Like I told you, but that's one of the unique selling points of unit trust fund, to get the higher return, because as you know, traditionally, where the lower the return, there's always a hitch. You know, it's either for example, savings accounts, the reason that the rates are so low is because it provides liquidity. And the reason that longer tenor instruments, the returns are higher, is because you're compromising on liquidity. So here you get the best of both worlds most of the time. And the final point is convenience, because the fund is so large. Like Udeeshan earlier said, we manage close to around 80 billion assets under management. And because our economies of scale, because the fund is so large, we are actually approached by companies that need money, because they can actually get the requirement of funds almost instantaneously from us, compared to going to the market and trying to secure a 1 billion rupee investment or a loan per se. As fund managers, it's easier for them to liaise with fund managers like us, because they can actually replenish whatever the borrowing component that they need very easily. And another thing is that because we are in the business of investing, we have insight to a lot of investment options. For example, as investors, you might not have information that a certain company is actually issuing a debenture, which is something that they would only promote or rather communicate to a very small community, or if there's a certain company that's actually issuing a commercial paper. So these information is not widely available, but only available to a small community, because the company that wants the money needs it fast, and they want it in very large quantum. And because we have that economics of scale, again, like I told you earlier, when you're investing ₹1,000,000 in a bank, compared to when a certain individual or a certain company invests 500 million to a billion, you actually get that very much a significantly higher return, because of the quantum is quite large. So because of that, it's again one of those ways that we kind of manage those returns. And when it comes to convenience gain, one of the other things that we provide as Cal is the ease of operating your account. So you can actually sign up completely online, and you can invest and withdraw your money completely digitally. It's almost like a mobile banking app, but little better, because you can actually earn interest on a daily basis, because all these unit trust funds have daily compounding interest. So you can actually view your portfolio growth, almost all of it, completely online. Next slide, Prisha. So if you take a look at our performance in the last couple of years, so 2016, 2021, we've always, or almost always, if not, been above the average weighted deposit rate. So average weighted deposit rate is if you take all of the deposit rates in the banking industry and you average it, these are the returns. So in 2021, when the FD rates were around 4-5%, our fund rates were around 7.8. And 2020, when COVID hit, that's when actually most of the people got to know about unit trust funds, and FD rates were really low, around 4%, if I'm not mistaken, 4 to 5% maximum, and the unit trust funds are actually yielding around 12 to 13%. So next slide, Asha. So to give you a little bit of insight as to what are the products that we offer products that kind of fit your requirement. So if you need a product almost like a savings account, a CASA account, the product to go for is the investment grade fund. So this is the largest unit trust fund in the country right now. We manage around 30 billion assets under management, and this is a short-term liquid fund. It's also the product that beginners who kind of might have reservations, who might, think, who would want to see how the company is and who does not want to take too much of a risk. So this is the only fund in the country that is double rated. Hello, very sorry. I think I just got dropped off. Are you sharing the screen, Asha? Yes. So getting back to where we stopped earlier. So like I told you, the investment grade fund is the product to go for if you're looking for liquidity and you're looking to use the unit trust fund almost like a savings account. And this fund is actually used majorly by, like I told you, individual investors who want to use the account like a savings account, and as well as big corporates who use the fund for working capital requirements, because there are certain corporates who invest in billions on one particular day, and based on another a procurement or any kind of expense that they have in a week's or 2 weeks time, then they redeem the money out. So the next fund is our new fund that we launched, called the Fixed Income Opportunities Fund. So this fund is very aggressive, and we chase behind returns very aggressively. So here the current AER is around 27.2%, and the fund is around 15 billion assets under management. So here, when I say it's medium-term liquidity, it's actually not even medium-term. The minimum commitment we require from an investor is to hold the funds only for a 1 month's time period. So any new investment you do, we require commitment of a minimum of 1 month. And then afterwards, if you want to take the money out without any penalties, you can take the money out. I'm sorry, I could actually mention this to you earlier. So all unit trust funds that we offer, in the situation that you want to withdraw, there are no penalties. Because I'm sure most of you are used to uplifting fixed deposits, and you need to pay a certain penalty to your respective finance company, your bank, in the scenario that you want to premature. But unit trust funds that we offer, we do not have any penalty as such. And the returns that we quote, so this 21% annual effective rate in the investment grade fund and the 27.2 annual effective rate of the opportunities fund are all net of fees. So we've deducted the fee component, and this return that we show here are the net of fees amount. So that's it from my side. And Sean will actually take you through one of the other products that we offer, equities, and how you guys can actually work through the equity side of things in this present investment climate. Thank you so much.
Thanks, Shehana. So as what Shehana mentioned, if you are managing short-term liquidity, if you're looking at how you can manage your liquid cash for any commitments which are coming up in the next couple of months, also the ideal product to go for is the unit trust. And if you want a complete solution similar to the savings account, investment grade is the account. You're making a 21% return compared to what you would make on a bank deposit of 3 to 4% as such. Right? And also, if you can lock in for about a month's time, the return that we can offer you on the fixed income opportunities fund is 27.2% right now. So the other big question right now is, last year was a great year for the share market, right? In terms of the equity market, in terms of the all share price index, we saw the all share price index going from 5,000 points to even 11,000, 13,000 points last year. But now it has started coming down, right? So is the share market the right product for you? Is equities, shares, the right product for you? Right? So it all depends on timing, right? When it comes to investment, not all investments are attractive at the same time. So when I'm talking right now, why we are talking about treasury bills and bonds and unit trust right now, because those are the attractive products in the market right now, right? There are other products, they aren't yielding sufficient return. So we are promoting these two products because that's where you should really look at capitalizing without parking your money in traditional bank deposits as such, right? So in terms of the share market, right, honest truth is that when interest rates are high, the share market doesn't typically perform well, right? So if you look at the graph here, it shows the negative correlation between the all share price index, right, and the interest rate. So when interest rates are low, like what it was during the last 2 years, the market performs very well, right? And vice versa, when rates are very high, right, the market doesn't perform too well, which is the typical scenario we are in right now, right? So interest rates are high. So unless you are making anything more than a 25-30% return on shares, you wouldn't really look at the equity market as such, right? So compared to last year, yeah, when you pick anything that moves up in price because the overall market is moving, in these kind of conditions which we are facing right now, when rates are high, index is not moving too much, you have to pick the right stock. So it all drills down to stock selection. You might have to pick the right stocks, which is where the expertise of Cal Research will come into play, who will kind of help you what recommendations to go at, right? So if you look at our model portfolio in terms of the investments that we've been recommending over the last 3 months, it has outperformed the market. So if you look at the market is down 19%, but our portfolio already is up about 9 to 10% already, right? So you need to pick those right stuff. By just investing in the market, you won't be able to make money in this kind of market. So be clear that it's not a market that you will just put money in right now. You have to pick the right stocks. Obviously, the equity market is cheap because if you look at how much the share, if you look at the market cap right now, in dollar terms, with the depreciation, the market cap, which basically represents the overall size of the market and the value of the market, has seen a substantial reduction, right? So the reduction is even lower than what it was in 2017 or 5 years ago, right? So it is cheap. The market is cheap. Just that it will take time for the market to bounce back. For you to see an upward movement in market again, or a significant movement in the market again, you have to wait until rates come down and politically things are right, us going into an IMF restructuring program. All that has to happen for equity markets to start performing, right? In the interim, you can pick those winners in terms of which companies will do well, but it doesn't necessarily mean that by buying the broader market in terms of you buy 20, 30 stocks in the market, you're not going to outperform in the market, right? And keep in mind now, even that treasury bills are giving you a 25% return, you should be able to beat those returns for you to keep your money still in the share market, right? Also, one more point is that what is the right time for you to invest in equities, right? The right time to invest in equities, particularly in a country which is going through a bit of a default scenario, us going to IMF, right? The ideal scenario is when IMF reaches a staff level agreement, when they are committing money, that's the point at which you should start investing in the equity market, because there's a clear path. From there onwards, if you look at the two cases here, we've shown Argentina and Pakistan as case studies, right? After the restructuring process happens, right, in terms of debt restructuring, IMF negotiations completing, you see substantial returns made on the equity market, right? So to make those big money on the equity market, there is still probably a couple of months to go before you can shift your money from fixed income to equities, right? And a couple of months down the line, you will see interest rates falling down, and then equity is starting to perform back again, right? So everything drills down to how you time the markets. Right now, treasury bills are yielding a higher return, right? So capitalize on that right now, right? Couple of months down the line, it might not be treasury bills. It might be the share market which is attractive, right? So by timing the markets, you will still be able to beat inflation, the impact of exchange rate depreciation, and so on, right? So to summarize, in terms of equity or share market, we are saying overall market is not going to move too much, right? Particularly until we reach an IMF agreement, IMF gives money, and interest rates start falling down, the overall market is not going to do well. But you still can make money in the equity market by picking the right stock. There are still stocks which are made at 30-40% return during the year. So with the help of our research department, you might be able to pick those right stocks, right? What recommendation should I be buying in right now, right? On the treasury bills and bonds, our recommendation is that you should be looking at investing long if possible, going for longer tenors, because these rates are not going to last for long. Right? You might not see this kind of rates in 12 months time, right? So capitalize on those rates now. At the moment, they are higher than the treasury bill and treasury bond returns, right? To manage your day-to-day requirements, the liquidity of whether it's your company or whether it's your personal bill, right? Use the unit trust funds, whether it being the fixed income opportunities fund or the investment grade fund. Use that to manage your liquidity, right? For example, even if you park your money, say for example, you get 100,000 rupees, right, as salary, right? If you take that money right now, right, put it as and when you get your salary, if you park it in the unit trust fund, right, you for a year you're making on that 100,000 roughly about 27,000 rupees, right? So for a month, just by parking your salary in the unit trust, you're making close to 2,500 rupees a month, right? By just parking for 30 days, right? And what you can typically do is you save your money and you run your expenses on a credit card, right? And at the end of the month, using the savings, you can settle your credit card expenses, right? So that's one way that you can manage your liquidity in the shop, right? So these are the products available in the market, and we hope we gave you a decent brief in terms of how this product works. But I'd be happy to take on questions from the audience in terms of any questions that you have in terms of investments, any doubts that you have. Feel free to drop in, and we'll be happy to kind of help you out. I already have a few questions which are coming. Let me answer them. One question is, the government can print and pay local bondholders, but isn't there a possibility that IMF might restrict Sri Lanka from money printing? IMF is very clear in certain things. So they will tell you to restrict money printing, but they can't completely say that you can't print money as such, right? Because in liquidity scenarios, when there are, for example, if there is a banking sector run, when people are suddenly withdrawing money from banks, right? obviously the central bank has to print and put money into the system. If not, the liquidity, the financial system will collapse, right? And also IMF very well knows that at the moment, Sri Lanka can't completely make printing to zero, right? It takes a bit of time. And when there are financial system issues, there are banks are falling, things like that happening in a worst case scenario, there is no real restriction that you can't just stay without printing as such, right? So IMF will only say you need to bring down your printing. You need to bring down so that in X number of months, you will bring it down to zero. It doesn't mean that from tomorrow onwards, you have to be zero in terms of money, right? So it's not a hard and fast rule that your printing should be completely avoided. Right? The other question I have is on what is a minimum investment for treasury bills and bonds. The minimum investment for treasury bills and bonds is 1 million rupees, right? If you take the route of investing in a treasury bill, because of the complexities involved in terms of managing that money, we charge roughly the minimum investment is about 1 million rupees, right? But if you are not having 1 million rupees and if you want to manage your money, take the unit trust route. By parking your money in unit trust, you can start your account with 1,000 rupees minimum, right? So your minimum value doesn't matter when it comes to unit trust. So if you're a smaller investor, take the unit trust route, because you won't have time to manage what you have, right? Give it to the professional advisors, the experts in this field, to manage your money, and they will time these markets for you, right? You don't have to waste time doing it by yourself, right? The other question is, will treasury bond rates come down by mid-August, right? If you look at the trend right now, treasury bills which were trading at about 20 to 23% suddenly saw its rates going up even 32% 2 weeks ago, right? And now rates are back down to about 27, 28%, right? We feel that there might be a little bit more downward pressure, given that if you look at it from a economic landscape, things are slightly better than what it was last month, right? Last month was absolute chaos. Right? There were fuel queues, there was no food, there were food shortages, multiple issues, political instability, right? That pushed up rates. So there is a little bit of downward adjustment that has to happen on the rates, right? But it doesn't mean that it's going to keep coming down immediately down in a continuous fashion, right? You might see a small reduction and it might stabilize until we see full restructural things happening on an overall perspective, right? The other question is why bank T-bill rates is much lower than Cal T-bills, like 26%, right? Let me tell you why, right? So if you look at historically, the bank rates were always higher than the T-bill rates, right? So what happens is, there is a limited amount of money in the system, right? What you and me have, say, for example, if we put it together, right, it might be about 10 to 12 trillion rupees that the system has, right? It's a limited amount of money, right? So what is happening right now is the government's borrowing requirement has increased, right? Because what has happened is the government, which was borrowing from overseas through sovereign bonds and so on, doesn't have that ability to borrow anymore, because we are default, right? And also our expenses are way higher than what it was before, right? Because of that, the government's borrowing requirement is pretty high right now, right? So traditionally, it's only the institutions which were investing in government bills and bonds, right? So if you want to attract people like you and me to invest in government bills and bonds, right, you need to move them out of the banking system, right? By increasing the rates, right, higher than the bank rates, what is happening is that people like you and me are shifting from bank deposits to government deposits or government treasury bills and bonds. By doing that, right, the government is able to fulfill its borrowing requirement. If not, you won't see the government being able to pay their bills. The government salaries won't be paid, right? So all that is managed with this money, which is raised through government bills and bonds. If the rates were lower than the bank rates, right, no one is going to give money. No one's going to lend money to the government right now, right? And that means that that the government will be unable to pay its expenses, right? For the government to attract money, shift people from the 10 to 12 trillion rupee deposit base into fixed deposits, treasury bills, they have to give a higher rate right now, right? A couple of years ago, the borrowing pressure was not that this high, right? Because we are borrowing through sovereign bonds, the deficit was low, right? The situation that we're looking at is completely different, right? Borrowing requirement is missed, right? So unless they give a higher return, it's difficult for investors to shift from banks to government securities as such. Right? The other question I have is, what are CAL's charges and taxes for T-bill purchases, right? Keep in mind that from 1st of October, this entire tax regime is supposed to change, right? So all these years we were just playing a WHT on interest before, and then from 2019, the system changed where you have to declare your interest and pay based on your personal income tax rates, right? But from 1st of October, it's going to be one tax rate for your investments. It's going to be 5% WHT, right, or withholding tax of 5%. So, for example, if you say your return was 24%, 24% into 95% is what you will get to the hand, right? It's going to be the same whether it's being a treasury bill or a unit trust or bank deposits. Going forward, it's going to be a 5% deduction from the interest that you made starting from 1st of October. So if the gazette is passed based on the current regulations, from 1st of October, on any interest on deposit or treasury bill or treasury bond, you will have to pay a 5%. Right?
Can I answer a question on unit trust? So there was a question on what is the percentage you charge for unit trusts. So it's a 0.5% fee that we charge, but like I told you earlier, the return that we quote is after that particular fee is charged. So the 21% in the investment grade fund, that is the running yield right now, is the return that we charge after that fee component is deducted, as at which even the 27.2% is after the 0.5% fee is deducted. So there was another question, can you lose money by investing in trust fund? Like I told you guys earlier, unit trust funds are one of the best vehicles to actually diversify your investments, and this can be done on behalf of you by the fund manager. And the way that you can lose your money, all of your money, for example, is if you had actually gone and invested all of your money in bank A, one of the leading banks in the country, and for some reason, let's say that bank actually goes belly up, just because you invested in that particular bank, one of the best banks a year ago, and now it's no longer the case, you will lose all of your money overnight. But in unit trust funds, because we actually diversify your investments in 20 different companies, so we also invest in certain banks, finance companies, certain corporates, PLCs that usual investors would not have access to. All of the companies that the fund has actually invested in has to go belly up or go bankrupt. There are 20 different companies that we have invested in the investment grade fund. All those 20 different companies have to go bankrupt for you to lose all of your money. And let's say, and also like I told you, there's a maximum exposure limit that we have, 15%. So in the scenario that the company that we have invested the most amount of money, that also goes bankrupt, only 15% of your funds will get impact. So there's another question, what is the value of the fund, gilt and money market? Sorry, are you referring to the net asset value? So the gilt money market fund is no longer active because it was quite a small fund, and the investors have actually pulled their money out. Right now, the investment grade fund is, on the other hand, it's not a money market fund, but we manage it in a way that it's quite liquid for our investors. And that is the largest fund in the country. So it's around 30 billion assets under management. And the other fund that we have right now is Opportunities Fund, that is 15 billion assets under management. Yes.
Sorry, I think someone else has asked what the tax on interest income will be. It will be 5%, right? So on any interest income made starting from 1st of October, the regulation is that you need to pay 5%. So it will be like the previous times before 2019, how banks will deduct that 5% of your of interest and send you the money. Right? A couple of more questions which are coming. So I think one very good question I think that a lot of people ask is, will there be a domestic debt restructure, right? Uh, for our audience who are not aware of this phenomenon, what a domestic debt restructure means is, at the moment Sri Lanka is at a default, right? So if when Sri Lanka is at a default, we are unable to pay our foreign investors, right? Particularly because we also don't have dollars, and also we don't have that income coming to kind of pay them. Right? So what is going to happen from an external front, from when IMF rules and whatever come in, that if foreigners has given us 100 rupees as loan, I'm telling this as an example of 100 rupees, what we are going to say is that we are unable to pay you 100 rupees, but we'll pay you 60 rupees back, right? That's what you mean by a haircut, right? On the amount that you've lent, right? We are saying, okay, we are not going to give you 100 back, we are going to give 60 back, right? So that's what you call an external haircut, right? So the question that our investors have is that on rupee denominated treasury bills and bonds, can the government come and say, if I give you 100, that in 2 months time that you will come and say you're only going to give 80 or 60, right? So a couple of things why the domestic debt or the rupee denominated debt shouldn't go through a haircut, right? First one is that if you make a substantial reduction on your foreign debt, say for example, if you make a 30-40% haircut on foreign debt, that reduces our debt to GDP quite substantially. It might even come down by 10%, right? Because what has happened with the rupee depreciation, the component of foreign debt has gone from 35% 2 years ago to now 45%. So it's a large component of your debt to GDP, right? By reducing the foreign debt, we can substantially reduce our debt to GDP, which can keep the external debt holders happy, right? But there are also other cases, right? For example, if the IMF, or it's not normally the IMF, it's the other debt holders who come and say, why don't you take a hit on the domestic or the treasury bills and bonds? The other reason is that if you do a hit on treasury bills and bonds, what happens is your banks, which are the largest holder of treasury bills and bonds. If you look at your banks, like the typical commercial banks of this world, right, hold about 35 to 40% of these treasury bills and bonds, right? So suddenly you will see banks losing 10% of their wealth, right? So it doesn't mean that keeping your money in banks will also be safe if that happens. So it creates financial system instability, right? So if you read the IMF documentation, what they're clearly saying is that in really worst case, when your debt is normally high, look at domestic debt restructure, right? But keep in mind that when you do a domestic debt restructure, it's going to create issues in your financial system, right? Banks will fall short of capital and so on. Then you will have to have central bank putting money in. You need to find people to pump back capital to the banks. If not, the banks will see a run on their money, right? People will start withdrawing if things like that, right? So because of that, the central bank or the IMF is more or less saying, be careful of your financial stability, right? If the domestic haircut, if you're going to take a haircut on treasury bills and bonds, if that impact is going to be large, right, on the financial system, don't do it, right? And in a case like where we are, a lot of Sri Lankan banks will fall below capital if there is a substantial haircut that they have to take on a domestic debt, right? So that is one reason why it's too much of a cost for the government to take, right? And typically, out of the restructurings we've seen historically, only probably about 5% of the countries would have seen a domestic debt restructure, right? The other view on domestic debt restructure is that the domestic debt restructure holders are people like you and me. We are holding bills and bonds, and the local banks and local institutions are holding, right? So when they argue at a debt negotiation table, you can say that that the local investors are already seeing an impact because of inflation. They are taking the hit on taxes, right? All the impact is being factored in there, right? So they are sharing a part of the burden, right? Not that the domestic investors are not sharing a burden. They are sharing a burden, but in terms of higher taxes, high inflation, a depreciated currency, right? So that's a strong argument to make. So we are saying indirectly, we are almost like a haircut. Your wealth, which was 100, is now 70, right? So the impact of depreciation has hit us. right? So there is a valid point to argue, right? There are multiple other reasons as well. Right? So one is the financial system thing, and also in terms of the government can also look at selling a few state-owned enterprises, right? So without cutting 5% or 10% on treasury bills and bonds, you might be better off selling $2-3 billion of state-owned enterprises, right? We have $1 billion in the port city, which we can probably sell off, right? There are assets. So the government is the largest owner of land assets in the country, right? So not that the government is unable or doesn't have assets, right? So in any case of a recovery, even if it's on an individual basis, if you don't have the ability to pay, if you have assets, you can claim from it, right? So if it comes to a point like that, right, the government can always put its asset in front, which they are now starting to talk about, right? That could also reduce your debt burden. So you don't have to entirely rely on domestic debt restructure. I know there's a lot of talk about it in the market right now, but we feel that it is a remote possibility, right? And even if you invest in, say, for example, at 25-30%, right, the maximum haircut that you're going to see, particularly on domestic debt, is going to be 10%, right? So say, for example, if you were investing at 25% in a treasury bill, now it might become 15%, right? In a worst case scenario, if there is a domestic debt restructure, right? That 15% is still the same that you're getting from a bank right now, right? So actually the yield is covering up for part of it, right? So at these high rates, right, domestic debt restructure is not a major concern, because still, even after domestic debt restructure, if it happens, even if it happens, the return that you make might be even greater than what the banks offer, right? So it's a very remote possibility, right? Even in countries, what we've seen where domestic debt has been restructured is countries which have almost a currency which is linked to dollars, right? Grenada, Bermuda, those are the countries which have seen haircuts, right? And these are dollar linked currencies, right? So Sri Lanka, given that it's rupees, the likelihood that by cutting down on the rupee denominated threat to haircut is not going to make a big difference in the equation, right? So what IMF typically looks at is you need to bring your debt to GDP down on a consistent basis, right? Not that tomorrow that your debt has to come down as such. So as long as central bank is very firm in terms of their view, Central Bank of Sri Lanka is saying that we are not in for domestic debt restructure. It is only on the sovereign front, right? If domestic debt is going to be restructured, expect even banks are not going to do it, right? Government might not be able to function. So it creates another set of problems, right? So weighing in the pros and benefits, pros and cons, the government or the whole restructuring process is better off just limiting it to external debt and handling other things through selling off state-owned institutions and so on. Right? So as of now, from a central bank's perspective, it's very clear that domestic debt restructure is not something that they would want to take. Okay. I see a ton of questions coming in our way. Okay. So the other question is, so what is the long-term and short-term suggestion for unit trust? For short-term, we would suggest the investment grade fund, and long-term, we'd suggest the fixed income opportunities fund. And how can I invest with Capital Alliance office and location? We are based at the Nations Trust building in Navamawata. You can visit us. To make your life easy, you can even fulfill this online process through online. If you log into portal.cal.lk, you can complete this entire process online, which is so without even visiting us, you can handle the process. But if you want a feel of comfort, feel free to always visit us at 46/53 Navamawata, Colombo 2. For unit trust, what is the minimum? We even facilitate with 1,000 rupees. We are happy to facilitate unit trust. Does unit trust need an account like stock market? It's not as complicated as a stock market account. Just log in to our online registration, fill in the details. It's a digital signature. We do a verification online, and your account is open. So it's relatively straightforward. You can open it within a day. Can you share Cal's perspective on the next quarter, second quarter macro? I think we'll have to have it as a separate section. But just to summarize, you might see a little bit more stability in this quarter. We feel inflation will start edging down. The only uptick that we see from inflation is if electricity prices go up. But if not, we are expecting inflation to start coming down. You might see the exchange rate seeing a little bit of stability, given that now we are starting to see positive figures coming from a trade balance perspective, which should typically trickle down in a couple of months' time. You should ideally get back your supplies which were running short. There might be an improvement on the supplies front, so things should be slightly better. So as long as you can strike the IMF staff level agreement and get money coming in, things might be looking better than what it was. Right. Our private wealth management solution, I didn't talk too much because it's a customized portfolio solution, and we only talk about private wealth management for anyone above 100 million portfolio.
There was a question on does CAL have a banking partner to open an IIA account, non-resident investors and one-stop solution? Definitely, we have the capacity to open accounts for non-resident investors. But to open an IIA account, you will have to liaise with your bank, that is any commercial bank that you have your money in. You will have to liaise with them, because we are not a financial institution who can accept money. We are just a fund manager. So we are the intermediary party which invests your money in different companies. So whichever money that comes in should come in via a commercial bank, and the money that goes out will also go to your commercial bank or any kind of savings account that you
have. Since there's a lack of time, and I think we've crossed our 1 hour session, we'll feel free to drop in an email to us. We'll share the details with you, or give us a buzz, and we'll be happy to help you out in terms of what you can do. But we'd like to have this session once in a while, at least once a month, so that we can kind of, and feel free to drop in any questions. And if you have any questions in advance, also feel free to drop in so that we can talk about it in our session. Right. So thank you so much for joining in. Keep in touch, and please reach out to us if you require any further assistance.
Thank you very much. So like I told you guys, we have a hotline number dedicated just for you, 0777 992525. And if you have anything that we can help you out with, just fill in the survey that we have also included in the chat. So we'll be more than happy to help you guys out. And thank you very much for your time, for joining us. And we hope that this session was of some importance for you guys for your investment journey ahead.